Okay. Well, good morning, everybody. It's kind of nice out today, sunny. It's beautiful here. I hope it's the same for you. We can't really see out the windows because we have the blinds closed, but I can kind of see a little bit of sun poking through. We are recording today's session. I've had a lot of questions about that. We understand you may have commissioner meetings, council meetings, things like that that you need to be getting to. So we are recording this session that you will be able to watch prior to next week's part 2. So we do encourage anyone who needs to watch it to go up to the webpage and watch it. So today is presentation day, or part 1 of the spring auditors conference. So like we said, there's going to be the 2 parts. Today is strictly presentations. We're going to go over a bunch of information with you, and then we're going to get together starting next week and do exercises that support your understanding of today's presentation. So they'll be pretty focused. You'll be able to ask us questions, more of a, walk you through the steps, answer those questions as we do it, as they come up. And we'll treat it like we did the quads, if you can remember, 2 years ago. So all questions that we get, we're gonna keep together so we can provide those to everybody in the end. We also will be, we're not gonna record those in person while we're there, because we don't want to be limited to standing in front of the podium to do that. It makes it very hard to do a virtual that way, but we are going to take everything that we learned from all 4, and we're going to record a YouTube video for each one of the exercises. So you'll be able to watch it later on and go back and see how we did it again, okay? Like a step-by-step guide. So as we get started today, we do have, we're gonna have, like I said, those exercises for next week. Lori and I are currently still working on those. But we do plan to have those available on the website, hopefully by Friday, but at the latest Monday. Okay, so be on the lookout. They're gonna be where the presentations were put up, so you'll be able to go and pull those down. We are asking you to go and pull those down and print them. We are not going to print and bring a copy for everyone, so you really need to make sure that you get on there and print it. We will have a handful of copies, but it's hard for us to carry all of those from unit to unit or meeting to meeting. So if you have any questions or anything like that, let us know. We will try and send out a reminder to go on there and print out your packet, I guess is the best way I'm going to call it, a packet. We haven't really determined what that's going to look like.
It's not going to be a lot.
No, it's not going to be a lot. I know the last quad we had some really thick. We're not going to do that this time. We're going to have just as much information, but it's just going to be different. So we'll make it limited amount of what you need to print, but again, please remember to print that before you come to your in-person meeting. Okay, I think I have touched on everything. I will say we do have the county box open. We are monitoring that, so if you're having a connection issue or something like that, please, you can send something through the county's box. We are monitoring the chat. Again, if you can choose everyone, ask questions, we'll try to answer those as we go along, okay? All right, well, look at me, I went a minute over, so I'm sorry. But with all of that said, we're gonna let Lori kick us off with the enhanced regulatory capital assets and accumulated depreciation. Yay. Oh, I need to make you
host.
I need to make you presenter.
Presenter, not host yet. I can share. Do I need to flip it?
I don't know yet.
Oh, I have to start my post.
No. Looks good.
Looks good.
Oh, I can see it now.
Is there a box or anything? I'm okay.
You're good.
I still have a box here for us. Okay. Okay. We'll jump right in. We talk about capital assets and accumulated depreciation this morning. So the last few times that we've met, even with COVID interruptions, we've been discussing the changes that we've made to the Enhanced Regulatory Financial Report, the AFR. That's what we generate off of what you load up on Gateway for your annual financial report. Some of those changes got delayed. We expected to have them in place for 2020, and that didn't happen. And so there was a memo that went out last year telling you because of COVID we're going to delay it. So we did not audit for those changes, and we did not make the changes to Gateway that we had expected to do that. But they were delayed, not completely removed. So we're going to be going ahead with those changes. We're not 100% sure on the timeline, but they're working with IVRC right now on getting those changes implemented in Gateway. So we want to make sure you guys are ready for that. So again, to remind you, the capital asset schedule was being shown as a supplemental schedule in the back of your audit report. It was not part of the financial statement or the notes, but the change is going to be that capital asset schedule is going to be moved forward. It's going to be an actual note to the financial statement. Instead of just showing your ending balances at the end of the year by category, it is going to include beginning balances, additions, deletions, as well as those ending balances. The notes to the financial statement, remember, are an integral part of the financial statements. We do place an audit opinion on those notes. Okay, that is not something we did on the supplemental schedules. There will also be a supplemental or additional schedule of accumulated depreciation that will accompany that schedule of capital assets in the note disclosure. While you've always had to maintain capital asset records, you have not been required to maintain an accounting of accumulated depreciation unless you were compiling GAAP reports. However, for the enhanced regulatory report, you will soon you will be required to also report your accumulated depreciation. So we are revisiting this topic in this presentation, and we'll be doing some hands-on exercises in the 4 meetings that are going to follow in the next 2 weeks, where we're going to determine how to determine your capital asset values and how to gather and determine your accumulated depreciation and do that schedule going forward. Now your capital asset, that is really an accounting concept. It is a deferral of cost over several accounting periods so that the costs are better matched to the period of time that they're being used. And if you participated or watched the session that we did on property taxes receivable, we talked about one of the differences between GAAP and the regulatory reporting is that concept of matching your expenses or your revenue to the time period where your expenses are actually incurred and your revenues are actually earned. And that's what capital assets do, is they take that cost and they defer it over the period of time that those assets are actually being used, so it better matches the expense over that period of time. For example, let's say you buy a new computer server and it costs you $15,000. So under regulatory, under cash basis, you would just expense that whole $15,000 in the first year. So you take that hit for that in the first year, and then you wouldn't show anything for the next 10 years. And then maybe you'd replace it and take that hit again. Rather than showing the entire expense in the first year, under this capitalization policy, you would allocate the cost of that $15,000 over the 10 years that you expected to use that server. So instead of taking the whole cost of it in the first year, you're going to take 1/10 of it each year over 10 years. So you're deferring that cost and you're pushing that cost over all of the years that uses that asset. Okay? So a portion of the cost is reported each year during the life of the asset, and that is called a depreciation expense. Under the enhanced regulatory, you are not going to report your depreciation expense directly. You could calculate it from your schedule of accumulated depreciation, but it's not something you're going to show up in your financial statements. And the unallocated cost then is your capitalized cost. It's still in your capital asset schedule. Okay. So for the enhanced regulatory report, your capital assets are going to be categorized the same as they have been. So you can have a land, building, improvements other than buildings, infrastructure, equipment, construction work in progress, and the last category is books or others. And these are all common expenses that where the expense that actually covers more than one reporting period, more than 1 year. And we're going to go over those in a little more detail so you have some idea what those are. So historically, our audit position has been, and I copied this directly from the Accounting and Uniform Compliance Guidelines Manual for County Auditors, that every unit must have a capital assets policy that details the threshold at which an item is considered a capital asset. Every unit must have a complete detail listing all capital assets owned, which reflects their acquisition value, and the capital asset ledger or Form 369 has been prescribed for this purpose. A complete physical inventory must be taken at least every 2 years unless more stringent requirements exist to verify the account balances carried in the accounting records. That is what the current requirement or audit position is for capital assets. Okay. So this is the guidance has been in effect for some time. You have been required to have a capitalization policy and maintain capital asset listings. You could have, and some counties definitely did receive a comment in their audit report if they did not have a capitalization policy or they did not keep a detailed listing of capital assets. The capital asset summary amounts by category at year end were then included as a supplemental schedule in the audit report itself. However, we did not audit the accuracy of the capital asset detail, nor did we place an opinion on the capital asset schedule. So that was the difference that we're going to go forward. In the future, we're going to do both. We're going to audit the records themselves, and we're going to place an opinion on the schedule as it appears in the notes. So again, there were 3 requirements that are currently required that were listed in the accounting manual. So the capitalization policy is the first thing. This does not have to be a long, detailed policy. We had training last fall from Mike Nielsen, and that presentation is still available on our website, his PowerPoint. I'm putting together a capitalization policy, some guidelines for that. You need to set a reasonable threshold for capitalization that works for your county. There is not one right answer. However, if you set the threshold too low, you set yourself up for a lot of work with very little benefit. There are many small purchases that are useful for more than 1 year, but tracking down every last stapler in your county would give me nightmares, and I'm sure it would you. That's an extreme example, but to wrap your mind around the concept, if the value of the asset is relatively low, it may not be worth your time to account for it on the year of purchase. So a stapler that may cost you $15 may last 10 years, but that $1.50 a year is not worth your time to track. However, you don't, on the other end, you don't want to set your threshold so high that you're not capitalizing a material amount of your assets. So, for example, if you set your threshold at $100,000, you would probably not capitalize many of your vehicles and equipment that fall below that $100,000 limit. That's not to say for a very large entity, New York City or someplace like that, 100,000 couldn't be a reasonable threshold. But the threshold needs to make sense for your county. So that is something that you determine as a county, and as long as it's reasonable, we're not going to argue with you. Again, if it's extremely low or extremely high, we might be talking to you about it, but it's a county decision that you're going to make, okay? It's also a good idea within your capitalization policy to have some sort of schedule of useful lives, because that helps you set up these accumulated depreciations that we're going to go through. We're going to be discussing the different categories for capital assets, and I'm going to talk about some different useful lives for each category. Again, this is an estimate. It does not mean that if you assign a useful life of 5 years to a vehicle that it will fall apart in the 5th year, or even that the truck has to be taken out of service by the county after the 5th year. This is a counting concept to allocate the cost, and the estimate is your best guess on how long that asset will be in use. At the end of a useful life, it will be fully depreciated, but it could still be in service. It's not an exact science. We don't expect it to be. You just need to have some kind of reasonable estimate for that. Once you have your capitalization policy, you need to list all of the items that are above that capitalization threshold. Remember, I said don't set it too low. Hopefully you already have your detailed listing. You should have it because that has been an audit requirement. And we'll go over the prescribed form next. as a side note, and we'll talk about this a little later, you should keep a listing of small but sensitive items such as tablets, cell phones, laptops. They may fall below your threshold, but they're higher risk for misappropriation, okay? Those items wouldn't be capitalized. We're not going to show them as capital assets, but they still need to be, controls still need to be in place so they're not being misappropriated. So here's one situation, or actually two situations, where the inventory serves more than one purpose. On the one hand, it supports the financial reporting accuracy. On the other hand, with those small items, it actually serves as a safeguard of county assets. So you see how it's serving both purposes, but we'll talk a little bit more about that. Every 2 years, a physical inventory needs to be done to verify the listing of capital assets and to make sure it's accurate and complete. We're back to capital assets. If you have a strong internal control over a perpetual inventory system, Ricky and I will be your biggest fans. You may not need to complete a full physical inventory, but our experience has been for most counties that departments are not always proficient at updating their capital asset listings for asset deletions or additions, and especially for asset deletions. So the inventory by department will probably be necessary. Again, if you have strong controls, you may not. It's going to be determined on a fact county by county based on the facts. If you keep your listing of equipment by department, you can copy off a detailed list of assets for that department, have the department head or their designee run an inventory and compare to that list, add any missing assets, or remove any that have been disposed of. It just helps you keep that inventory more manageable, that listing, detailed listing, so you're not carrying things 10 years, 15 years down the road that you don't even own anymore. This is the current prescribed form for a capital asset ledger. It can be kept by fund and or department. You do not have to use the prescribed form. If you have an alternative form or you have software that will provide the same information in a report, that's perfectly acceptable. The alternative form of the software report would have to be approved, but you can go ahead and use your alternative form even before the approval. It just needs to go through an audit. We need to make sure it provides the necessary information, and then it can be approved. If there is missing information or the form or software, then that form of the software can be modified to provide the additional information, so you don't have to throw the whole thing out. You just make the necessary modifications, and then it can be approved. Chapter 1 of our Accounting and Uniform Compliance Guidelines does provide the process for getting alternative forms or reports approved, so you can go to that if you have questions. Okay, what this form captures in the first column is the date of purchase or acquisition. That is important. That date is important. And as the accumulated depreciation is started with the year that the asset is acquired by the county. Then you record a description of the asset. That description needs to be unique enough to describe the asset. If your description is truck, that will probably not be sufficient to identify which truck. If you include the year, make, and model, you provide more accurate information. So when that truck is sold or traded off, you know which line to record the disposal on. A serial number is important. It can be a serial number applied by the county where you assign it. It can be the manufacturer, such as the VIN on a vehicle. It can be a serial number applied by the manufacturer as well. It just provides identity, detail identity, so you can identify that asset for tracking purposes. Location of the asset also helps identify the asset. So is it held by the park? Is it held by the highway? Who actually, the sheriff department, who's actually holding on to that asset. The original cost is an important value to have. We are deferring that original cost, so we need to know what that cost is. If you are in the unfortunate position of compiling a detailed list of assets currently, then you're going to be including many assets that were acquired a long time ago. Your courthouse, parkland, jail buildings. Those assets may be fully depreciated at this point. However, you still need to record them as accurately as possible. We're going to discuss estimating the cost of an asset in those cases. Once your asset listing is up to date and all your additions, from that point on, all your additions should have invoices or claims, contracts, everything that will help you keep the original cost of that asset accurate. So it's only getting that, if you're already up to date, you don't have to worry about that estimated useful life, because you're going to use what's actually the actual cost of purchasing it or constructing it. Estimated life, again, is important for determining the accumulated depreciation. We'll talk about that a little bit more. Data disposal is also important. This is often missed in capital asset listings. I have audited many a listing that has equipment and vehicles, again, that have unit no longer even owns, but they're still carrying them. Even if those items are fully depreciated, their inclusion in the capital asset schedule inflates both the capital asset listing and the accumulated depreciation amount. So if you don't own it, you want to get it off the list. Also makes your list more manageable than carrying a lot of assets that you don't have anymore. And then you take the original cost or the estimated cost if necessary and allocate that to the appropriate category, whether it's land, infrastructure, buildings, improvements other than buildings, machinery, equipment, vehicles, or books and others. And we're going to go over those categories so we kind of clarify what those are. I've included an example. This was from the workshop that we did in the quad meetings. And this is just an example, so to kind of illustrate what we're talking about. And this is taking that manual form, and again, you could have a report or an alternative form. Again, this doesn't, as you see on this, the form doesn't have a totals line because you don't know how many lines you're going to need in a given year, but you can draw a line at the end of the year, and just like we have here, and create a totals for that line. And then when you're looking at the first line, the 12/31/2018, there's a total for each category. So 11,000 in land, 750,000 in infrastructure, so on. Okay, and those are the numbers that you're going to or have been putting into Gateway, into the schedule there for year-end numbers directly off of your details. And that would have looked something like this. And again, you would have had a schedule within Gateway that said land, I have 11,000, infrastructure, 750, just straight from those numbers from that form. I just want you to see the correlation to that, because this is what we're looking for when we audit. We start with the schedule that you've provided us, and we want to trace it back to the detail listing that supports those numbers. That's what we're looking for. Remember, these numbers are completely made up. They have no relation to actual facts. So do not take these in any way to be that important. They're just to illustrate how the schedule works, how the form flows into that schedule. And I've actually included an actual supplemental report, so you can see these are much more respectable numbers for what a county would have. So this came straight out of an actual audit report. Yours, would look pretty similar based on your actual numbers. Again, I hope you're looking at your audit reports and you would be familiar with this. But this is what we've been doing so far, getting to this point, getting to this schedule right here, which was a supplemental schedule in the audit report. Again, there was no opinion on it. We just put this information out there for the reader. Okay. What that means is when the reader of the audit report was looking at this schedule, they had no assurance that it was materially correct, as we didn't audit the numbers, we didn't put an opinion on them. In moving the schedule to a note disclosure, we are now providing that information that we have looked at these numbers, we have audited them for accuracy, for completeness, for several other things. And although this is not a GAAP report, because in GAAP, the schedule capital assets would actually be part of the financial statements. Here, it's only going to be a note disclosure. We are putting an opinion on it, saying that this schedule, as it appears in the notes, is materially accurate and can be relied upon.
We do have a question.
Yes.
It says report totals do not include books and others.
I'm going to go over books and others, and the reason it doesn't, if you don't have that category, it's not going to be on here. So these are more common categories, but if your category is zero in some, if your total is zero in some category, you're not going to include it in there just to show zero. And most counties aren't going to have books or others. We're going to talk about that in a few minutes. So the newer schedule, again, is going to provide more information to the reader than just this year-end capital asset information. And the accumulated depreciation is also going to provide additional information on capital assets as a whole. It tells you kind of where you're in purchasing and controlling those capital assets. So let's look at those categories now, including books and other. Okay, so we're going to start with land. All land is capitalized no matter what the acquisition cost is. So if you pay $1 for land, you're still going to capitalize your land. Okay, that's one exception there. It's always capitalized. Unless, I guess there is one exception, unless it is purchased for resale and it's part of an inventory. So think about maybe your redevelopment commission is holding land in inventory, or a land bank is holding that. Those would not be capitalized as land, been part of the county's capital assets. So those are going to be separate. But for the most part, what you're dealing with, land that's owned by the county, that's going to be capitalized. So you have land under a courthouse, maybe land under a parking lot, land that you built a park on, land that in easements that are associated with a county highway or road. Okay, counties may own land that's not for specific use yet, and it might be leased for farmland. That land does need to be capitalized. It's not being held for resale. It's just being held until the county decides what to do with it. It needs to be capitalized. Okay. Get questions about it ever, something, those kind of details, be sure call Ricky and I will be glad to talk it through and figure it out together. So land is always shown separate from the other asset. So if you have, courthouse on your capital asset schedule, you're going to have amount for land, you're going to have amount for buildings separate. They're not going to be combined into one. The location and the amount of land, as well as the date acquired, the purchase price should be included in the capital asset record. So if land is donated, then you're going to use the fair market value at the time of donation. So if someone gives you land, find out what it's worth, and go ahead and use that value. Land, for the most part, does not wear out. It doesn't get used up by the county in their ongoing operations. So it does not have a depreciation expense, so it's always shown separate under assets that are not depreciated. There are exceptions. If you have a landfill or a cemetery where the current use of the land diminishes its future use, there's some different special things that you use for that. If you have those type of assets and need help posting them, again, let us know. We can help you work through that. So infrastructure are the systems that support the county's operations. These are things like your county roads, highways, bridges. That's probably the biggest for counties, your stormwater and drainage systems. Even if you have communication networks set up, that can be part of your infrastructure. For cities and towns, this often includes their utilities or electric, water, or wastewater systems. Those items tend to last longer than other, like equipment and vehicles do. They tend to be non-movable. So think roads and stormwater drains. They cannot be moved without a whole lot of work and equipment. It's a major project to move them. Valuing these systems can be difficult. They were acquired over a period of time. Not all of your roads and bridges are the same age for varying costs. However, for roads and bridges, your highway department already tracked the miles of road, the age and condition of roads. Same thing for their bridges. They often use the software developed by LTAP. That's a program out of Purdue that helps categorize and assign costs to those roads and bridges and tracks the accumulated depreciation. So this number is one often that you don't have to calculate. So as difficult as it may be, it's often one you don't have to worry as much for. You get it straight from the highway. I did look up some of the variants, and again, so that's why your highway engineer is going to be much more valuable on this. Roads can last anywhere from 20 to 50 years, asphalt roads 18, gravel 8, bridges around 75, and again, your highway department is going to be much better at determining how long these things usually last or when they need to have major reconstruction or replacement. Buildings are your permanent structures, so they don't move at all. So think of your courthouse, your jail, highway garage, park buildings. Your capital asset list should include the location of each building, the acquisition cost, whether you purchased it or you constructed the asset, any improvements to the building. So you might have built it in 1 year and maybe 10 years later you add on to it and renovate it. If it's a major reconstruction progress, those costs need to be added. This is a category where additional capital costs versus repair maintenance costs come into play. If you significantly extend the useful life of an asset or how it is used, its capacity, you make the building bigger, then you need to capitalize that cost. If you're maintaining the building in its current capacity, you're painting it, you're putting a new roof on it, those are maintenance costs, and those usually are not capitalized. You just expense those in the years it happens. Useful life is often set at 50 years for buildings. Again, this does not mean at 50 years you move out. This is a deferral of cost over the useful life of an asset. The estimate needs to make sense to the county, and 50 years may be the average time before a building has outgrown its usefulness or needs extensive renovations to continue to be useful. You don't have to choose 50 years if a different useful life seems more appropriate. Based on the building, are you talking about the courthouse or are you talking about a highway building? The quality of the building, was it a limestone construction or was it a Quonset hut? And how will it be maintained? All of those things factor in how long you think that building will be useful. And that's how you're going to estimate that. And again, I'm going to say this several times, it's what's reasonable, and we're not going to argue with you if it's reasonable. You guys know what your useful life is better than we would. Improvements other than buildings are improvements to land that are not permanent. They're not considered buildings. These are things like parking lots or fences, landscaping. They're not permanently attached to the buildings themselves, but they do have a useful life of more than 1 year. Often the useful life will depend on the type of improvement. I did some searches. I found that parking lots are often shown at 15 years, sidewalks at 40 to 80 years, depending on what the sidewalks are constructed out of, whether they're asphalt or concrete. Fences are given 15 to 20 years, again, probably dependent on the type of fence, construction material. Landscape is usually set around 15 years. I mean, trees can last a long time, but one bad storm or a tornado can take them out. So the average seems to be about 15 years. And again, these are just guidelines. These are not absolutes. Do not go back and think that your capital asset useful life has to follow this listing. These are just guidelines. Based on the history, if you talk to your park people, you get a better idea of how long your park improvements are lasting. Fences, talk to your street people about sidewalks, all of that information can factor into that. And again, as long as it's reasonable, we're going to go with it. Equipment is probably the one that has the most change year to year, and it has the shortest useful life. So here we're talking about machines, trucks, cars, highway equipment like bulldozers and graders, computer servers, safes, office furnishing, office equipment, scanners, copiers, security scanners, large tools, etc. Again, as we discussed, if there are smaller items that are at higher risk of misappropriation, like electronics, smaller tools, you might want to use an inventory system to attract and account for those to ensure they're not walking off the job. This would not be a part of your capital assets. GASB sets a recommended practice that the threshold be set at least $5,000. It can be set higher depending on your county needs, so if you want $10,000 or $50,000, but review your detailed listing and see if there are numerous smaller items. You might want to consider raising your threshold on that if there are a lot of smaller items that may be taking a lot more effort to track than they are to depreciate over time or to keep on your capital asset detail. But it should not really go below $5,000. That's the recommended practice. If you choose to do that, we're not going to write you up for that. It's just going to be a lot more work on your part. And remember, when you're applying the threshold amount, it's applied to each individual asset, not a group of assets. For example, if you purchase 10 laptops for $2,000 each, so your claim is $20,000, you're still looking at what was each individual laptop and applying that. So if you have a $5,000 threshold and the laptop was $2,000, doesn't matter if the claim was $20, you're still going to say, oh, those are below the $5,000. I don't need to record those as an asset. There is an exception to that on collections, and we're going to talk about that next. Another thing you need to keep in mind is equipment purchased with federal dollars needs to be separately identified and carried on your capital asset detail as a federally purchased asset. So somehow you need to flag those so that you are tracking those as purchased with federal funding. Examples could be a bus if you have a mass transit system and you use federal dollars to buy a bus. I had one county that had an elevator purchased for their county home, but they used federal dollars for that. Fire departments have fire trucks, things like that. All of these assets have additional requirements for use and disposal, and for their per their grant agreements, they need to be tracked as part of the compliance with those federal grants. So it's something you need to remember. If your threshold is $7,000, but your grant agreement requires you to track all assets purchased grant funding at $5,000, then you got to track those the equipment purchased with federal funding at $5,000, even though it's below your threshold. So just keep that in mind. Okay. Estimate for equipment is often 5 to 10 years. A sheriff vehicle may have a much shorter life than a pickup that's used by your surveyor doing his corner perpetuation work. So keep all of that in mind. Your department should have a pretty good idea what the average life of their equipment is. Your vendors may be able to provide an estimate of when the asset would need to be replaced. During an audit, again, we're not going to question you about whether you used 5 years or 7 years, as long as the estimate is reasonable. I know there are trucks on the road that have been on the road for 50 years that have been lovingly restored by their owners, but really trucks in government service don't usually last 50 years. So that would probably not be a reasonable estimate. And we might question that, but 5 to 7 to 10, I think we're going to be okay with that. Okay, here was the one that was questioned earlier, books and other. That's a fairly new category we've added on the form itself. So let's start with the first thing, the reason it was added. If you are a library, you're going to assign a value to your collection as a whole. Okay, so a book might be $25 and well below any kind of threshold, but the collection as a whole is what the library was established for. That collection is very important to a library. So tracking that as an asset and the changes in that is very important to a library. So that's a separate collection that they're going to keep as a collection and report as a collection, and there are additions from that collection and depreciation to that. I don't know many counties that would do that. It's possible that you might have a very extensive law library or something that you might want to track as a library. I think it's highly unlikely, but I'm not saying you don't. So if you do, then you could put that as a collection, and again, then you would depreciate that. What's the life of it, and how you're going to do additions to that and deletions from that as law books, newer law books are purchased. But these collections, again, are depreciated because they are used up. Books get worn out when they're used and they have to be replaced, or they're no longer pertinent. They're no longer have current information and have to be replaced with new things. There is another classification of collections with an indefinite life, and those are museum or historical collections. If you have a county historical museum or an art collection possibly, and the purpose of the collection is to display or for research, the collection is being adequately maintained, the proceeds from sale of any one item in the collection is used to purchase new items for the collection, you are not required to report or value these collections. And that kind of makes sense. It's really not part of your operations as a county. I'm not devaluing. I love history. I love historical museums. I like going to them. So I'm not devaluing the value, but as far as the operations, and remember, the capitalized costs are the deferral of costs over the period of time. These museums are separate, okay? You're not using them up. There's a separate collection, and again, you have specific reasons that you're holding them for the purpose of history, to allow your citizens to see this history, and they're kind of contained in and among themselves, and so they can be held separate. They do not need to be part of your capital asset inventory. You can if you want to. They are not depreciated, but you can.
What classification would be used for law books?
It would be a library. If you were going to do that, you would do it as a library or books. If you have sufficient funding in your law library that you think it's important enough to capitalize and report that, it would be under books and other, and it would be a capital asset that would be depreciated. But just bear in mind, there's two separate things to that. So a library where you're actually using the books, patrons are coming in, citizens are coming in, and they're reading the books, they're using them, so they're getting worn out by use. They're getting worn out because laws change and you need more, is a different situation than a history museum where you're collecting history and you're just holding on for display purposes. And the final one we're going to talk about is construction work in progress. This is in situations where the asset itself is being constructed. You're building a new county jail or another county building. You're building new roads. You're building a new bridge. It's necessary to capture the cost of the construction during the construction period. So even if that construction period lasts a year or two, you want to gather all of the costs as it's being constructed so that you have that accumulated cost reported when the project is complete and that asset is then transferred and put into service. So the bridge is ready to drive across, the jail is ready to hold inmates and be operated as such. Then it becomes the asset that it was intended to be. It becomes a building, it becomes infrastructure. And so it's moved out of construction work in progress, it's put into the category it's supposed to be in at that point, and from that point on it is depreciated. Not from the, you don't start from the first cost that's accumulated, you start from when it's put in service. Okay. So during the time that's in a construction work in progress, it's not actually been put in service, there is no depreciation cost. And so it is actually held up under the land category, under capital assets that are not depreciated. And those are all of the categories. We're going to move on to valuing your capital assets. Capital assets are valued at their historical cost or acquisition cost. Remember, this is an accounting concept that allows us to defer the cost of the acquisition over the useful life of the asset. The purpose of the capital asset listing is not to report assets and how much everything is worth. Not your fair market, not your replacement. It's not saying this is everything we own and this is how valuable it is. It's to defer the original cost of the asset and to allocate that cost over time. Okay. We all know that our historical courthouses are worth far more than what we show in our capital asset ledger, both in replacement costs, historical value, sentimental value. They're just priceless. But that's not what a capital asset listing is. It's the acquisition cost allocated over a period of time. It's for accounting. Okay. So if you are currently trying to put your capital asset detail listing together now because you haven't had it kept up to date, you will find there may be numerous assets that were acquired sometime in the past. You have to find that it's historical cost, and that can be daunting, challenging. For your equipment, machinery, vehicles, you should have claims. There shouldn't be any problem with those because most of them don't last 5 to 10 years, and you surely should be able to go back in the last 5 to 10 years, get all of the claims to provide those costs. Land and buildings that were purchased 50 to 100 years ago are the ones we're talking about. You can look for any documentation, old deeds for the land, board minutes where it was purchased, if you have your board minutes or permanent records, even word of mouth, if somebody knows what happened back then, to try and determine how long the county is owed a particular asset. If those sources do not provide the historical cost, there are ways to estimate that. One way is to determine what the current cost would be or the replacement cost, and then using a consumer price index, calculate and estimate the cost at the year the asset was acquired. The consumer price index and method of calculation can be found in the March 2020 bulletin. I put it here on the slide on pages 11 to 12. So we've made that available to you. You can go and look at that. If you have any problems applying that, we will be talking about it and when we do our workshops or quad meetings. But if you have any problems about going forward, again, always call us. So this is just a screenshot. That doesn't show the whole table because it wouldn't all fit. But there's an example in here and it shows that there's an asset with a current value of $76,000. It was constructed in 1930, which is not shown in here, but you went to 1930, the index is 0.07. So you take the 76,000, multiply that by 0.07, and you come up with a value of 5,320, and that is what you would put on your acquisition cost. And you would keep documentation of how you came to that $5,320 somewhere, where you got your replacement cost, this table, that you use this table, and that's how you came back to that number. So once you have all your assets listed with your acquisition date, your description, and now you've got your acquisition cost, you need to assign that useful life. We've already discussed some ideas of useful life for the various categories. Again, there is no absolute answers for useful life. It just needs to be reasonable. It's an estimate of how long that asset will be useful to the county. It's helpful if there's a range set out in the capitalization policy to kind of set guidelines so you're not reinventing the wheel every time you get a new asset. However, the county's own experience with similar asset provides very useful information. How often do your sheriff department vehicles need to be replaced? How long does a piece of highway equipment last in your county? Engineering estimates used to plan projects can also provide useful information. If your county is working on a new jail project, part of the estimate cost and options may be an estimate of how long a jail this size will be sufficient for the county. You can also check with other counties. See the range used by them, maybe find a county that's close to your size, and look at their capitalization policies. You can look up useful lives on online. I just Googled them and looked up various ranges on that. IRS provides guidelines. There is more related to taxation, which are not something you're concerned with, but it is another estimate of useful lives, and it's something that you can go by if those seem reasonable to use. All of this, again, the IRS and those other publications are available online, and they should be relatively easy. I mean, it's going to take some time to track them down, but once you've got them in place, then you go forward. You should always keep documentation of how you made that estimate, what you used, and why you determined it's reasonable for your county. As long as it's reasonable, we're not going to argue with you on it. Okay, so the new concept we're having is the depreciation. And this is a new area you have not had to calculate or track before unless your county does GAAP financial statements. Depreciation is the mechanism for allocating that cost over the useful life of the asset. Remember we talked in the very beginning about this. Okay. The simplest way to do that is straight line, and that's the only one I'm going to talk about. If you have questions about other methods, you can call us and we'll be happy to talk to you about them. But to compute a straight line depreciation, you take the cost of the asset and you divide the cost by the number of years in the useful life estimate. So each year gets an equal portion of the cost. The only slight complication in straight line depreciation is determining when to start that depreciation. Most assets are not purchased on January 1st and disposed of on December 31st. So when an asset is purchased partway through the year, you need to have a policy. You need to have how your county is going to determine how much to depreciate the first year. You can still go with all of it in the first year. You can go with half if it's purchased within a certain time. Again, that's going to be a county policy. It is best if you set the policy in your capitalization policy, then everybody's using it uniformly. Okay. An example could be your county could decide that any asset purchased between January 1st and June 30th would receive a full year's depreciation, and anything between July 1st to the end of the year would get a half a year in that first year. That's just an example. You can, like I said, you can have a full cost the first year if you want to. So let's look at an example. We're going to carry it through several slides, so kind of keep this in mind. We purchased a truck for $50,000. We've determined that we think it's going to last 5 years. So to determine the depreciation for each year, we take that $50,000, we divide it over the 5 years, and we come up with $10,000 per year. What that means is that we are recognizing $10,000 of the cost of the truck each year for 5 years. So if that truck was purchased between January 1st and June 30th, year one, we would still show $10,000. However, if we had the policy that I just talked about and the truck was purchased between August or purchased in August, our policy was to take half a year at that point, then we would only show $5,000 in the first year, and then take $10,000 for each year, and then in the last year take the final $5,000. So we're going to use our truck example, so keep this in the back of your mind. We're going to talk about accumulated depreciation. So for the enhanced regulatory, we don't report the depreciation expense in the financial statements. We do, however, show the accumulated depreciation in a schedule along with the capital assets. For our truck that we purchased in the first half of the year, okay, in year one, we have $10,000 of accumulated depreciation in year one. We purchased it for $50,000, so year one we would show $10,000. At the end of year 2, we've added another $10,000 of depreciation. So at the end of year 2, our accumulated depreciation is $20,000. Year 3, we've added another $10,000. We've got $30,000, and so on. At the end of year 5, we've gone through 5 years, $10,000 each year. So our accumulated depreciation is $50,000. Our truck was worth $50,000. That's what we've got it on our capital asset. We've got our depreciation at $50,000, which means it's fully depreciated. Okay. We'll talk about book value a little bit later, but our book value would be 0 at this point. Okay. If our truck was purchased in August, and I didn't put it on here because I thought it would be too confusing, but if our truck was purchased in August and we did the half a year, the first year instead of $10,000 would be $5,000. But in year 2, we would end $10,000, so we'd have $15,000, and then $25,000, and then $35,000, $45,000, and then $5,000 in that 6th year for a half a year, and we'd still end up with fully depreciated. Okay? Okay, y'all with me? So your accumulated depreciation schedule is the summary of this calculation for each of the assets in your capital asset detail. Okay, with the exception of land and construction work in progress, which don't have depreciation. But for every other asset that you have in that detailed listing, you're going to have a calculation like this. So I'm going to talk about some of the reporting requirements. This is what the new capital asset schedule could look like. And this is taken from our draft report, and we've talked about it in earlier presentations. And again, instead of just having that last column, ending balance 12/31/19, that's all the numbers we would have shown before. We've got a beginning balance, additions in each category, reductions, and an ending balance. The beginning balances would tie to the prior year's ending balances. Okay. If you haven't been showing your ending balances, then that's going to be, you're not going to have those prior year ending balances to tie to. But if you've been keeping them all along, so your summary, your supplemental summary schedule is going to tie to that as well. The additions, the second column is for additions. Again, now that you have your detail listing in place, you're only looking at 1 year, your current year purchases or construction. You need to have procedures in place to capture the purchases during the year that need to be added to your capital asset ledger. Those procedures may vary from county to county depending on your staffing, your software, and other resources. Some will flag all the claims over the threshold for review at a later date. Some have software that will capture the information on purchases over the threshold amounts and produce a report or add them directly to the ledger. Many claims will come from capital outlay classification, that expense line for capital outlay, though it's possible that you can have a capital outlay that came out of another category, because I have seen that happen. So just be aware of that. During an audit, we'll often scan the ledger for disbursements from capital outlays. So look for things that should have been capitalized and then test those to the detail ledger to make sure they've been picked up. That's a common audit step. Some counties use a capital asset addition form that each department has to complete and attach to their claims whenever they purchase a good or equipment or anything over that threshold amount. They attach that form to it. I hope it goes without saying, even though I can't go without saying it, you need internal controls to ensure that whatever procedures you have established are being followed and are working to provide accurate and complete capital asset additions. So it's not enough to set these procedures in place. You need to make sure they're working, that you're getting those reports, that the flagging is being done, that it's producing accurate, that it's not missing things or adding things that it shouldn't. So again, you've got to have controls in place. You also have to look for reductions. This has traditionally been a difficult thing. It's always been a little more problematic because you don't always have documentation. You get claims, so you know what they're purchasing even if the departments don't tell you. But unless they've traded in an asset, so it's on their claim where they're showing it as traded in, you may not know that they've gotten rid of something. When it's scrapped or sold at auction or given away, you may not have records for that. Even for trade-ins, they may not specifically identify it enough for you to be able to take it off your capital asset report. So you need to kind of have some procedures in place to make sure that you're picking up when assets are sold at auction or salvaged. Hopefully there's a listing provided to your board for them to declare them salvaged. So your board minutes may have at least a report that the department is going to have an auction to sell some items at salvage, and you may be able to get a detailed listing at that point. And finally, again, you can try to rely on those biannual inventories to weed out the assets that no longer belong to the county. Again, print out the department's assets, have them review them, and tell them what they still have and what they don't have. Okay. And oh look, those clever little internal controls just managed to sneak in on another slide. Make sure you have controls in place, that whatever procedures you establish are being followed. Now we're going to talk about the next section of that. So you're going to have your capital assets, you're going to have your beginning balance, additions, deletions, reductions, and ending balance. And then you're going to have your capital assets that are not depreciated. So you've got your land, construction in progress are separated out because those do not have any depreciation. Okay, so those are separate. Then you have a separate section for those that are being depreciated. They're pulled separately in the schedule, so they're identified separately. So your infrastructure, buildings, improvements, and machinery, those are the capitalized numbers. Those are the amounts that you have capitalized on those. But those are also being depreciated, and beneath that schedule is the actual accumulated depreciation for those. So if you take your infrastructure, the 1.5 million, and subtract the infrastructure beginning balance for accumulated depreciation, then you know what your book value is on your infrastructure. We'll talk about it in a little bit. Okay, so you've got one section, the very top section, which is just your land, construction in progress, and then your assets that are depreciable, and then the depreciation itself. And that's what the new note is going to look like. And again, this is a note to the financial statements. So it's not in the financial statements themselves, it's in the notes. So we stated, we'll go back to that, the accumulated depreciation schedule is a summary of the accumulated depreciation for all capital assets in each category that are being depreciated. The beginning balance, again, would tie to the prior year. The first year that you present accumulated depreciation is going to be the most complicated because you're not going to have those beginning balances. Okay? You don't have a prior report to rely on. You will have to calculate the beginning balance of accumulated depreciation as it would have been shown if you've been keeping it all along, and we're going to get back to that. The additions represent the depreciation expense for that year, which is being added to the accumulated depreciation. So that column would actually show the depreciation by category. This would come from your depreciation schedules. However, we don't have a prescribed form for tracking depreciation, so we're going to use a spreadsheet. We talked about it when we did the quad meetings before, and it's a very simple way to do that, and that's an easy way to go forward with that. Reductions will be removed from the accumulated depreciation for any assets that were disposed of. So when you take the asset out of service, you also pull that depreciation associated with that asset at the same time. Okay. And the ending balance can be calculated from the other three columns, which is your beginning plus your additions minus your reductions. Okay. That number in this column then will tie back to your capital asset detail ledger. So we'll go back to our truck example. We're just looking at the truck now. So in the first year, we were adding the purchase cost of the truck. So year one for the truck, which didn't exist before that, we started with a beginning balance of 0. We had our $50,000 acquisition cost. So our ending balance in equipment is $50,000. Okay. Our lesser accumulated depreciation, again, we didn't have anything, so 0, but we have $10,000 of depreciation if we bought it in the first part of the year. So our accumulated depreciation at year end for equipment is $10,000. Year 2, the value of the asset doesn't change. So $50,000 just gets carried over to the ending balance. But the accumulated depreciation gets another year of depreciation. So the $10,000 plus the additional $10,000 has that accumulated depreciation of $20,000. That was on that earlier slide. Each year we added $10,000 more. Year 3, same thing. 50,000 doesn't change, but we've added another year of depreciation. So now we're up to accumulated depreciation of 30,000 at the end of the third year that we own that truck. If the third year were the first year that we were to show this, this was our current reporting year, we would start out with our accumulated depreciation of 20,000, even though we didn't show it before, and do the addition of 10,000 and have an ending balance of 30,000. And then of course, again, the capital asset itself would have on the records at 50,000. And again, this is a sample of the depreciation. I just kind of modified it and stuck our little example in there. Because you're going to do this for every single asset that you have, and this is a very simplified version of it. But for each asset that you have on your list, you're going to calculate this accumulated depreciation. So our pickup is in here. I think this was year 2, not year 3. I should have done year 2. So in year 2, this is our depreciation schedule. So our original cost is 50,000. Our useful life is 5 years, so our yearly depreciation is 10,000, just like we calculated. In year 2, our beginning balance was 10,000, plus we added another 10,000, so our accumulated depreciation is 20,000. That gets added to all of the accumulated depreciation in machinery and equipment to come up with that 41,840. And all of the different sections, it's the same way. Okay, you come down to those gray lines, which are the summary by category that you have. This is why a spreadsheet is so much easier to do that. Then those totals are taken to your report. So that very bottom part of the schedule, your accumulated depreciation, you have your beginning balance, the additional accumulation that comes directly from that spreadsheet, and then what your ending accumulation depreciation is. And all of these numbers then can tie back to this schedule right here. So that once you get to this point, these are the numbers that you're running into Gateway. Am I out of time?
You have a few.
Huh?
You have a few.
Okay. Okay, I talked a little bit about book value. I want to talk about that a little bit more. You probably have heard the term book value before. Book value is your carrying value, is what it is on the books. So this is the asset value less the accumulated depreciation. Again, this is not market value, but the carrying value on the books, hence the term. Why do we need this information? What does it add to the financial statements? Knowing how much a county has invested in capital asset provides more information than just telling them what your cash and investments are. This is why capital assets are included in GAAP statements of net assets. Accumulated depreciation also shows how old those assets are in a class as a whole, how close they are to needing to be replaced or have considerable reconstruction or renovation to keep them in use. If they're only, say if your assets are 3/4 of the way depreciated, then you're going to have to start putting some outlay to replace them or reconstruct them if it's a bridge or something or a road. If they're only 50% depreciated, then you've got a pretty good balance of keeping things in check, and you may not have facing a lot of large costs in the future or immediate future. So it does add additional information to the readers of the financial statements, just as the information on debt and leases do. Again, by adding some of the GAAP components to the enhanced regulatory financial statements, we hope to bridge the needs for the financial statement readers, which includes your financial institutions and your rating agencies and all of those, with the needs of the units, so that we're not requiring all of our units to have to provide GAAP financial statements, which is a whole lot of work. It can be done, but for something, I guess I would not be as concerned about the counties, but when you get down to the libraries, the townships, small towns, that it could just be a whole lot of work for them to provide those kind of statements that they may just not have the resources to do. And for some of our counties, that may be more than what their resources allow as well. And so that's what we're hoping to do by providing this additional information in the notes to get them the information that they're really looking for without having to go full-blown GAAP financial statements. And then one more thing on physical inventories and I will be done. So again, unless you have extremely good internal controls over your capital asset addition and reductions, and I'm not saying I haven't seen them because I have seen them, where they really are good at capturing all of the additions and all of the deletions, and they have controls in place and they make sure that those procedures are being followed. So they keep a very good perpetual inventory system. They always know what they have. You probably need to still have that capital asset inventory done every 2 years, an actual physical inventory where you say, count how many you have, go through your title file, make sure that all of your capital assets tie to the titles that you're holding to them, looking at what you actually have in place. You can do it more often than 2 years. You could do, again, like where you print out what you're showing for a department and asking them to review those and double check as well. There are various ways you can do that, but again, the physical inventory, I cannot stress that can be very, very important for keeping that capital asset, because it can become very unwieldy if you're keeping a lot of assets that you don't have anymore, and it can be very, you're going to get comments if it doesn't contain all of your current assets on it, if you're not picking up material assets that you've purchased or constructed over the years. So you need to have that in place. And then again, the inventory is a secondary for safeguarded assets. If you have small items that can be higher risk of misappropriation, again, think of laptops and cell phones, tablets, small tools in your highway department. If there are some of those small tools can be very pricey. And again, if their potential is that they could disappear, it's a good idea to have an inventory of those and have the people that they've been assigned to responsible for those and keep those inventories up to date. If you have any questions, you can always reach out to Ricky and I. The county's email is here, our phone number is on there, our website is on there, has information. We do have a YouTube on capital assets currently. We will be doing a YouTube about our work on the accumulated depreciation. We're also doing another one on accumulated depreciation that we're going to be posting. Yes. There's going to be some other resources on there, so keep watch on that. Are there any other questions?
We have a question. I waited because it wasn't in theme with what you were talking about time. So this is kind of a couple questions here. So if you were determining the cost of construction, is the engineering cost included in the construction cost?
The soft costs really depends on what, partly on your county policy and partly on what it is. Sometimes you do kind of exploratory costs where you can set out for an engineering cost, puts together what the costs are, and then you may or may not do the project. So in that case, those costs would probably be expensed at the time. If it's directly related to the project itself, it certainly could be capitalized. That's going to be a county decision. And again, it just needs to be reasonable. It needs to make sense that this is part of the cost.
All right, the next question is on vehicle costs. So say you have a truck that costs $30,000. The dealer gives you a rebate in the amount of $5,000. So the county is only paying $25,000. What do we use as our cost of the asset?
Remember, what you're capitalizing is your cost over the period of time that you will use that asset. So if the truck only costs $25,000 to the county, that's what you're going to use. Your capital assets are not a list of this is everything we have and what it's worth. This is everything we had and what we paid to get it. Okay, so it's going to be if they give you a discount or you negotiate a better price, it's going to be the acquisition cost, what you actually paid for it, not what the fair market value is or what you could sell it for. If you add equipment to it, that equipment by itself may not be, but if it's integral to it, you could also include that in the capitalization, especially if it's, if you buy a sheriff's vehicle and you're putting the lights and all of that, the cost to get it to where it needs to be on the road, those can also be capitalized.
That's it.
Yay, I'm done. Thank you very much.
Okay. I'm sorry, there is a question. While I'm setting this up, you can answer this question. What about vehicles we are leasing to own? Wait a minute, sorry, hold on. What about vehicles we are leasing to own? When is that reported as a county asset?
If it's what we used to call a capital lease, if you are planning to own it at the end of the period, then you would capitalize it when you purchase it at the beginning of the lease. If it's not a decision you've made yet, then you probably would not capitalize it until you actually make. So if it's like a copier and you can lease it for 3 years and then make a decision to purchase or not, and you don't know whether you're going to do it, you probably wouldn't. But if you're using the lease as the financing to own that vehicle, you would capitalize it at the beginning of the period.
All right, I got one more thing and then we'll move on. It says, mostly I've been dealing with an inherited asset list. This list is kept up to date annually, but it does have assets that are less than the $5,000, but listed as a group, so 5 computers that total $10,000. Can I go through this list and clean it up, eliminating all those assets that do not qualify as over $5,000 without repercussion because of previously reported amounts?
Yes, you can. If you need to correct, normally, if you need to correct your capital asset beginning numbers, it would be a note disclosure, but you could still be done because we have not put an opinion on beforehand. This is the best time to correct those because they've just been supplemental schedules and we haven't put an opinion on it. So yeah, go ahead and correct them and make sure that you've got the most accurate listing right now.
All right, we are going to move on because we are just cutting out of time.
I'm sorry.
That's okay. We knew this was going to be a big one. So luckily we're going to come out and see you and we can talk about these a little bit further. So we are going to move on to receipt disbursements and classifications. I don't know if you guys have kind of noticed there's kind of a theme. We're starting to talk about enhanced regulatory a lot. We know that it's been a couple years. You know, we really were pushing it, like she said, and as COVID came up, we just kind of pushed back the complete implementation of it. So as we're starting to kind of get back in the swing of things, we need to kind of do these refreshers and these reminders, you know, to make it easier on you moving forward. So one of the things we want to talk about today is receipt and disbursement classifications. This is really, you know, really kind of key and when we're moving to put the financial statements together. So to begin, oh, sorry, I can't move it forward. There we go. We're going to start with the chart of accounts, which hopefully everyone is, you know, aware of the chart of accounts and is using it. So the chart of accounts was implemented in 2012. Obviously, this was done to standardize the record keeping across the state for all counties. Okay, this was done kind of in together at the time Gateway was being put together, so that if the chart of account numbers flow through to Gateway, it makes it easier for when you go to report. So when you look at our chart of accounts, if you go to the Auditors page of our website, you're going to see, if you scroll down a little bit, you're going to see chart of accounts. And I will show you that here in just a sec. But it consists of 3 different documents. So you've got the chart of account instructions, you've got the fund and account tables, you've got the fund and account descriptions. We're going to go over those just a little bit as we kind of move forward. So these documents all together are our chart of accounts. They all play a key part in your reporting process and recording your records. So here is the website. Hopefully you're familiar with the Auditors page. This is going to take you to the Auditors page. I just did a screenshot, so if you scroll down, you'll see chart of accounts. I just did a screenshot here so you could kind of see what it looks like. You will see that we do keep dates on the fund account tables and the fund account descriptions. We're pretty good about maintaining those. Every once in a while one slips through. We did notice chart of account instructions is going to need to be adjusted a little bit, so it's still relevant, but there's just some tweaks that need to be done to it. So the chart of accounts is broke up into these 3 different documents, but I want to kind of start with the instructions themselves. So the instructions have the valuable information of, you know, your fund numbers, your fund types, your definitions of what things are, the receipts and disbursement account classifications, major and minor. You've heard us speak about those, along with the description, along with other descriptions as we're going to kind of go through. And I kind of printed it out just because I wanted to kind of, as we talked about it, just to kind of see it. It even goes through in the very, very beginning the type of funds, your statutory funds. You'll hear us talk about statutory funds all the time. Those are funds that are created by statute. All right, so there's a specific statute that creates that fund, tells what revenue is going to go in there and how they're used. But you have other funds like local authority funds. Some of those where a really good one I can think of off the top of my head is like buggy fees. You're gonna have taken buggy fees. So maybe you create a fund to hold those buggy fees in if you're one of the counties that do that. Along with things like your federal grant funds, all of that. If you go into the chart of accounts, you're going to see how we break it up by number. So like your 1,000 series are your statutory funds. Your 4,000 series are your local authority funds, and so on. But in the instructions, this does kind of go through all of that. Okay. Briefly, I want to talk about why these are so important to make sure that these are marked properly when you are receiving and dispersing inside your ledger, because this is what you're going to be uploading into Gateway, and this is what's going to turn into your financial statements, okay? So you need to look at each one of your funds, and you really need to make sure that you determine what the fund type is. A lot of these have kind of been done for you on the account tables. It's the one that's done in landscape that's long. It's got several columns. You can kind of look over there and see it. It doesn't mean this is 100% accurate. Some of these may be based on what you're actually using it for. Okay, and we'll kind of get to that here in a few. But the different kinds we're talking about, obviously your general fund is going to be your general fund. That's its own fund type, okay? We always show the general fund separate. But special revenue funds, capital project funds, debt service funds, these are funds that need to be identified because they are going to be shown separately within their category and separately on their own, which is kind of, as we get that finalized, we'll kind of talk to you guys about those. But the schedules are important, and how you classify them on your end is how they're going to roll over into Gateway, okay? We also talk about enterprise funds, which you may not have any of those. The others you're going to have. I mean, you work on capital projects, you do debt, you have special revenue. A lot of your grants that are going to come in are going to be special revenue, things like that. Your lit funds, things like that. But enterprise funds is another one that you may have. If you question that, you can call Lori and I, ask us. But really, any kind of enterprise fund, it needs to be self-supporting. Okay, so you're not. We talked about the EMS. I keep wanting to say ambulance. EMS, same thing, sort of. But your EMS, if it is a completely self-supporting entity, I don't want to call it entity, part of the county, but it doesn't need any other county money. So everything that it's billing and taking in is completely self-sufficient, then it's possibly an enterprise fund. Take a look at that. But if the county is really majorly supporting that, then in that case it would not be. As you kind of go through the instructions a little bit more, it also comes down to fiduciary fund types. So these are things that are going to be like your pension trust funds are going to be in this. So there's some other like private purpose trust funds. You've heard us talk about like agency funds in the past. That's now going to be called custodial. I don't know how far that's going to get down to you guys. But money that you're holding on behalf of somebody else. So like clerk's trust, for example. Clerk's trust, they're holding money on behalf of somebody else. So once that judgment comes in, they can release that money. That would be an idea of custodial. So that would fall under your fiduciary funds. Again, instructions. The other thing that's not in the instructions, which we are adding, is we're going to add a category called other funds. This is really something at the moment that's going to be for like clearing funds, like your payroll clearing fund. You've got a fund, it's just the payroll, you're holding it there until you're sending it out. That is just where that's going to kind of show itself, okay? So that it's kind of separate from the other funds, okay? And we're not trying to, You know, a lot of times you're pulling it out of like general fund and you're putting it into that clearing fund. This is just instead of trying to do the accounting to show it one time, we're just going to throw it over here and say, really, that's what this is. It's just these clearing accounts. So make sure that that is marked as other as you move forward. I don't want to go any further on that. So these are just some of the important parts that are inside that instructions. But we also have the, like I said, the fund and account tables. I always get these two mixed up for some reason in my head. But the fund and account tables is the one, like I said, that's done landscape. So it has got several columns on it. We do have a fund type marked in here. It's a code 1 through, I want to say 11, right? And that code's on the very last page at the bottom, which I know you guys can't see because I didn't print this, but it is available to you. But it's there. It does talk about the function of the fund number that's assigned to it. They're all broke down by, you know, is it a statutory fund? Is it a local authority fund? Is it a remittance fund? Those kinds of things. So this is really, really helpful. But the one that I find the most helpful is your fund descriptions, because if you're going to call me and ask me what you can use a fund for, this is the first place I go. While I am not a wealth of idiom statutes like some people, some people are. Lori can do that right off the top of her head. This is my cheat sheet, if you want to call it. So if you call me about a certain fund, I will go find that fund, and then right next to it, especially if it's a statutory fund, it's got the statute right there. It tells you where it's created, what the use of that fund, it's all right there. So it's just really kind of a nice resource. I actually keep one printed and on my desk at all times. Okay. All right, so before we move in a little bit further, I want to talk about a couple funds that we're finding that are being used that no longer exist. We kind of touched on this last year when we removed some funds that they really weren't being used, but they were just there. We went ahead and removed them. While we were doing that, we did find these 5 that were actually kind of heavily used. We decided not to just delete them. We decided to spend this year talking to you about them, but they will be gone when you go to report next year, okay? So this is the time to do something about them. The first one we have here is the Child Advocacy Fund. At one time, the statute had it set up where the county actually retained 50% of the child abuse prevention fee, but that statute has changed, and now it's 100% of that goes to the state. So there should be no fund for this anymore because you shouldn't be holding any of that money, okay? This is something that the clerk kind of turns over semi-annually when they turn over their other state fees. The other one we have is the emergency telephone system, the 1153. There were 2 funds that were set up for the counties to account for the E911 funds. They were received from like landline phone bills and wireless phone bills. The state 911 board currently collects the fees for the state and distributes those fees to the local PSAPs. So the 2 funds that have been established are now obsolete, okay? So any balance that is left in that fund should be transferred to the E911 fund, which is Fund 1222. All right, and only the statewide E911 fund should be used. Okay. The next 2 I'm going to lump together because they are very similar. These are the reassessment funds. So in the past, there were separate funds that were established to account for the costs of reassessment. There were 2 funds on the chart of accounts, this 2009 and 2015. But currently, the counties are using a 4-year cycle to reassess all property, and the fund, and so the fund was established to account for the costs of that reassessment, and so now we have reassessment fund, which is just called reassessment fund. There's no year attached to it, and that's 1224. It's the only reassessment fund you should have, so you should close those other 2 out, okay? One other one that came up was the Homestead Credit Rebate Fund. So Some of these I had to do some research on because they were before me. So back in 2008, somewhere around there, about that time, the state advanced a sum of money to each county to pay a refund to all property with homestead exemptions. Any amount that was not used was to be returned to the state. Okay, so that only the amounts left in this fund really should be for uncashed checks that should have gone to unclaimed property. And there might be some possible interest in there in which the county could keep that. Any outstanding checks from the homestead rebate need to be remitted to the Attorney General as unclaimed property. So with all of these, you need to take a moment, okay? Not at this moment, sometime here in the future, okay? Not right now, don't leave me. You need to determine if your county has these funds open, and if so, take the proper steps to get them closed out, because what's going to happen if you don't is you're going to be calling Lori and I and saying, hey, this fund doesn't no longer exist in Gateway, and we're going to say, yeah, we know. You remember that virtual meeting and we kind of talked about it? So so that's just to kind of take a step moving forward, okay? All right. I don't even know how I'm doing on time. Not great. Okay, so we may be breezing through some of this fairly quickly, but the lucky part is we are going to go through all of this stuff again at the quads, okay? So I kind of wanted to talk about the major classifications. I'm not going to get into the minor ones. Those aren't the ones that are going to show up on the financial statements, but these major classifications will. So these are really kind of important to the enhanced regulatory and getting back on track. We are also going to be auditing these classifications. So my question is, why are they needed, right? I mean, why do we need these classifications? Well, I tried to put those up here on the slide. So detailed revenue accounts within each fund, first of all, they're required for the prescribed uniform accounting system. It also allows the readers of the financial statements to know what revenues are associated with what funds, okay? And it promotes transparency. So I copied a lot of this from past financial statements. Some of it came from the chart of accounts itself, because I wanted to have it all in one location where you could see it. But for your major classifications, this is really what kind of revenue are you getting? Where's it coming? So is it taxes? Is it your wheel tax, your innkeeper's tax, your food and beverage tax, any lit? Property tax, that kind of stuff. Those are taxes that are set by the county, levied by the county, okay? That is where that classification is going to be. But you also have licenses and permits. So these are amounts received from other businesses. So I thought of building and planning permits. Those are things that you would have to go. In fact, we added onto our house. I had to go get a permit to do all of that. When they receive my money, they're going to classify it as licenses and permits, okay? Intergovernmental receipts, I think sometimes gets a little tricky, because sometimes you're getting money, you're getting money from the state and you think, well, that's my financial institution tax, so that's tax. Well, really it's intergovernmental. Okay, it is money that you are getting, and technically it is a tax that you're getting, but it's not something that was put in place by the county. It's the state has got that, and then they are divvying it out. Okay, so you're getting it from another governmental unit, so it's an intergovernmental receipts. This would go with like grants, your MVH distributions. I forgot they're listed on here. That's what I copied. Your CVET, as we like to call it, things like that. Your wheel tax, your excise tax.
Wheel tax.
Did I say wheel tax? Surtax is what I meant. I was looking at excise surtax. Sorry, excise surtax. Normie, not wheel tax. You're right, that's by county. Okay. Another classification would be charges for services. So anything that you're receiving money to actually perform a service. So, you've got 911 telephone on there, copy machine charges, accident report copies, gun permit applications, things like that, okay? Again, these are really important to make sure that we're classifying them properly. All right, and towards the end here, we have fines and forfeitures. So these would, you know, I'm thinking of a city. I got a speeding ticket and I go pay that. That's a fine that I'm paying. I don't get speeding tickets ever. I'm a good driver. Maybe a parking ticket or two though. I know. But the one I really wanted to touch on here is other receipts. And the reason this one is it's so easy to say, let's just put it's just another receipt, right? Well, it's the best one to end on for the receipt accounts because all receipts coming into the county should not be classified as other. If you're classifying everything as other, there is no way to tell what revenue streams are coming in, how much of each. They're just lumped with everything, okay? Most receipts that you're going to get, that you're going to be doing, are going to meet one of the other classifications, okay? So really kind of think that through. Think about the fund that that's going into. Think about the fund type that it is and how that classification meets with that, okay? So other does have its place. We're not saying it doesn't. It does have a place, but it's more for things that only happen, once or twice, maybe a year. They're so minimal that there's not really a point in having its own category, okay? So putting things like, your inter-fund activity, ordinance, we get court orders, your internal service receipts, things like that. These are so small, okay, compared to the other stuff that you're collecting. So, like I said, when you put everything in there, you're not being transparent into what you are actually receiving. So by accounting for the receipts in these proper classifications, it allows a reader to compare multiple years. So you could you could pull a couple audit reports and look at, okay, what were the taxes that were collected each year. That's a better idea of, if you're looking at taxes per taxes classification to compare versus other and other. You don't know how much is broke up into that taxes, or what's fines and forfeitures, or what's charges for services, okay? So comparing, you can compare your charges for services, your fines and forfeitures, what are you collecting, is it going down, things like that, all right? And again, we will be auditing for these, okay? But they are done properly. I feel like I'm hurrying. It's because I am. We still gotta get through disbursements. Okay, so disbursements real quickly. This slide should look really, really familiar. It's just the flip side of receipts. Again, you're required for the prescribed uniform accounting system, okay, to have a detailed disbursement accounts within each fund. This also allows the readers of the financial statements to know what the county's spending money on, okay? And it promotes transparency. Like promoting transparency. We like that a lot in government. Okay, so to run through these really quickly, and I'm sure most of you know these because, well, you're auditors and you deal with the budgets and everything else all the time. So disbursement, major classifications, personal services, your salaries, your wages, things like that, okay? Supplies, obviously, if you're buying copy paper or staplers. You're buying a lot of staplers. I don't know. Things like that. This would be the place that would be put. I think we probably follow disbursements maybe a little bit more closely than receipts sometimes, only because you are following a budget as you're spending forward. But other services and charges, are you contracting with somebody for professional services? Okay, if you are, you're paying that, or that is where you're going to classify that. Debt service, are you paying off a debt? Okay, capital outlay, are you buying land, buying a building, are you improving on a building? Those kinds of things would be under capital outlay. But again, we have other disbursements. All right, so again, same thing. It's a great one to end on, though again, I don't think we have as big of an issue with disbursements here, but it's just like receipts. okay? Not everything's gonna be classified as other. Most disbursements are gonna meet one of the other major classifications. And when you're, sorry, I lost my train, okay. Yeah, so by accounting for disbursements with the proper classification, this really kind of allows, several things. Again, you can compare and see what your payroll costs are from, one year to the other. People can go on and find what your budget was for the year. I mean, that's public information, so they could compare budget numbers to what was spent through the financial statements broke up by those classifications. This really does help give the important information for reviewing the financial statements of a unit. All right, it lets people know where you are financially. So what I do want to do is reiterate that we will be auditing for these classifications moving forward. When we meet in person, we're going to be doing an exercise on determining proper classifications and how that flows through the report and what the report's going to be looking like, okay? Wow. I went through that really, really fast. And I don't know if there's any questions, because...
Nothing's come in, unless you're not sending it to me.
Hold on, I'll look. But you guys really wanted to just talk about capital assets, so...
There's so much more fast.
Okay, I don't see anything else, so we're gonna move over to the other one, which is gonna probably be just as quick. My long one's in the afternoon, sorry guys. All right. This one we've kind of talked about before. Let me make sure, yep. Nope. I don't want to let you guys go late for lunch. I don't know if you're hungry. I'm starving. And when you have to be in Indy at around 6 and you're eating at like a little before 5, noon can't get here soon enough. Okay. Or we've just lost everybody. Okay.
We're still good. 119.
Yay. Or they just got up and walked away. It's fine.
All right.
So, this one is really kind of a quick one. This is going to be one of the smaller exercises that we do, but this became a huge topic of conversation when we updated our gateway uploads. Form 61. Oh, what's the Form 61? So we know you guys are all using computer software and things like that. And so you may not have the prescribed Form 61, but your system should have something very, very similar, or maybe even use two. Maybe even have two different reports that make up what would be used in place of the Form 61. So I think the question kind of came up because inside the directive and inside the user guide, the Form 61 reconcilement is listed underneath the auditor's requirement and underneath the treasurer's requirement. And this is because each county does it a little bit differently, okay? And so we don't need both of you to do it, we just need one. But we kind of wanted to kind of talk about it because that kind of forced other questions to come up. And so we did answer quite a lot of questions on this. So let me see if I can do this in 20 minutes. All right, so we have some new auditors here too, so that's kind of a helpful thing for them as well. So again, important, auditor's role is you're the fiscal officer of the county. You're keeping the official record, official ledger of the county. The treasurer is the investing officer of the county, holding the cash. That's their primary role. So with the auditor and treasurer, segregation of duties is largely handled in the Indiana Code. We've talked about that numerous times. In fact, the presentation that I kind of used, I kind of based this one off of. We did a lot of statute in there. But really, you've got to remember that care needs to be taken to maintain that segregation of duties, okay? I did put a few statutes in here, but it's not as heavy. So I put this one in here because this one talks about where the auditor shall keep an accurate account current with the county treasurer, okay? So you have your ledger, you're posting your receipts, you're posting your disbursements to the official ledger of the county. But here is where the statute is that sets up that, hey, you're to keep this account, but you're also to keep it current with the treasurer. Well, in order to do that, here's the statute that talks about the treasurer shall maintain a separate account of receipts and expenditures from each fund, okay? I think sometimes this gets a little confusing because I think when we're using a software, we're thinking of it all as just one ledger, but really it still should be two separate. The treasurer should be maintaining their own, the auditor should be maintaining theirs, which is where the Form 61 kind of comes in. It's a way for you guys to reconcile together so that each has a proper accounting. Okay. So we put in like the receipting process. I'm not going to go through all of this stuff. I know we've done it 1,000 times before, but the auditor posts to the official ledger of the county. Okay, so when that money comes in, well, the treasurer collects the money, they post to their record, and then they make the deposit. All right, these checks and balances, you're still both posting to your own set of records. All right. So same thing with disbursements. While the auditor initiates the claim process and posts to the official ledger, the treasurer is verifying that there's enough cash in the bank and they're posting to their records. Again, checks and balances. This is done all the time, right? I mean, this is part of daily operations. So, when you're maintaining the segregation of duties, there's a few things here. When the auditor posts a receipt or a disbursement on their side of the ledger, it should not automatically post to the treasurer's side. Because then you're just reviewing the auditor's ledger to the auditor's ledger. Does that make sense? Even though it's on the treasurer's side, it should be two separate records, not one record copied. Okay? And other things that are here is, the auditor should not have access to the bank account. The treasurer is the investing officer, the custodian of the cash. That is their role. The auditor is the, official fiscal officer, keeps the official record of the county. All right. So, but as the auditor shouldn't have access to the bank, the treasurer should not be able to initiate the claims process. Okay. So there shouldn't be payments that the treasurer is being able to make without the auditor. That's an auditor function. Okay. Sometimes I think these computer systems kind of come in and don't think about the way it would manually work, and so sometimes things are overlooked, not as a meaning to be overlooked, more of a, oh, we can automate this process, that makes life easier kind of thing. And so we need to take a step back and make sure that we only have the roles that we're assigned to have. Obviously, you'll hear us say this all the time, teamwork makes the dream work, right? So while the treasurer maintains the custody of the cash and the auditor maintains the funds ledger, both need to work together to prepare a monthly report and the funds ledgers, okay? So that Form 61, I think, is actually called the monthly report. There should be one for each side. So at least monthly, you should be getting together and reconciling those, okay? Now, which I'm already slide off there. All right. So, as you're reconciling this, I want to make sure I didn't go. Yeah. So, you guys should be getting together to reconcile at least monthly. At least monthly. Sometimes it's easier to do daily. That way, if you're off, you have one day to go back and look to see where the differences are. But in statute, it just says monthly, at least monthly, okay? So we would strongly recommend doing more than monthly, especially with the size of counties and the amount of transactions you do. that's a lot of times the question, oh, I'm off from the auditor by such and such amount, okay? So once you do this reconciliation, this is what should be uploaded into Gateway. Now, it could be the treasurer that does it, it could be the auditor that does it. We don't care who does it. It only needs to be there once. So communication is key here. But I want to emphasize that both the auditor and treasurer should be involved in this process, okay? The auditor should be verifying that these amounts that's on their ledger is correct. The treasurer looks and says these amounts are correct. They are identifying the differences in between, okay? When you're doing the reconciliation, you really need to be looking at the difference not only with your total overall balance, but you need to be looking by fund. Do you have the same amount of receipts in general fund on both sides? Do you have the same amount of disbursements in general fund on both sides? Is the balance the same on both sides? Okay, so it's more than just a one number reconcilement. All right, we need to be reconciling everything. Every transaction should be mirrored in both sides, okay? But you need to take into consideration things that maybe wouldn't hit one side versus another. So let's say a good one is voided checks that I put on here. So let's say the auditor decided, something comes in, you wrote check out, oh, some mistake happened, we have to void that check, but you never tell the treasurer about it. So the treasurer's still carrying this check as like an outstanding check, even though it's been voided in your system. Okay, that could cause a difference between the fund ledgers at the end of the month. All right, so those would be things that you would need to identify. Maybe even doing a fund transfer. So a big one is when we're talking about the MVH and the MVH restricted sub fund. When we talk about doing the transferring of expenses from one to the other. In those kinds of cases, even though it doesn't change, the overall balance in there, it does change the amounts in the MVH fund and the sub fund, okay? So those kinds of things need to be considered, they need to be documented. Now, if you have a report that prints out, treasurer's got their side, here's the auditor's side, we're comparing and there are no differences. I mean, it agrees 100% all for all funds all the way down, then I would just suggest sign that form, scan it in, and that's your reconcilement because you don't have anything to identify. You're already reconciled. If, however, you do have some of these little differences on each side, then we need to see the reconcilement. So we need to see where you identified those numbers, where those amounts come back to each other, okay? And that is what we're looking for you to scan and put into Gateway. So I do know that some I've seen are, some of the uploads I've seen are just the computerized version of what their Form 61 looks like, and maybe they've handwritten at the bottom. It's really just a couple different items. They've identified them, that's fine. It could be a spreadsheet. Really, it can be however your county, whatever works best for your county in the process. But it still needs to be done by both sides, okay? It's really important for one thing is that number is what the treasurer carries on the cash book, okay? That number is how they reconcile to the bank. So you guys are reconciling those two ledgers, but then they are using that in their other reconcilements. So this one is extremely important, especially if we're coming in to do an audit. We're gonna audit and reconcile your bank to your financial statements. Who puts the financial statements together? The auditor, you're the fiscal officer. Who does the bank reconcilements? The treasurer. So, from my experience, like I've always said, you guys are really two offices that are two sides of the same coin. You have to work together in order to get this there, okay? And to get the financial statements and the funds ledger and the bank reconcilements all to agree. So communication is key. I'll be honest, this is a very quick presentation that I threw together. I'll just tell you, I did have my COVID vaccine last week, and I had a horrible, horrible side effects for one day. So, but luckily it was a very quick one, and I was over and done with it within a day. All right. Do you guys have any questions?
I think you had some I didn't get.
What? Oh, questions?
That's how you get the stuff that
No, I didn't see. Okay, hold on one sec. Oh, we did. Okay, let me go back up. Some of this is inventory. Did I go too far? I think I did.
It's after that, I think.
I think that's still part of inventory.
There.
All right. What do we do if the treasurer's cash page does not match the Form 61 generated in the financial software? Sometimes our treasurer says they do not match our funds ledger monies. Not sure why they wouldn't, since those amounts come from their funds ledger. I mean, there's a line on the cash book that says funds ledger, so I think I'd have to have more information or actually see what they're talking about to be able to answer that, but that's where they should be pulling their numbers from. What if the treasurer is not balanced since the beginning of the year? Do I go ahead and send this report or wait until she is balanced? This is kind of a tricky thing because you want to be in compliance with doing your uploads, but you also don't want to upload incorrect information. And if she's not balanced, does that mean that the funds ledgers on both sides aren't balanced? Or does that mean that she's not reconciling to the bank? Not really sure. I think call us, let us know the situation, and maybe we can kind of lead you further with that. So if it's something to where the fund ledgers are really reconciled, it's just the cash book part that's off, I would say go ahead and upload it. Get it in there so we can at least see it. If it is off across the board, call us. We need to have a conversation.
We need to know that.
And maybe we can help sort it out and get you back on track. But I don't think, you uploading your Form 61 that's not reconciled with the treasurer because they're not balanced or their ledger's off or whatever, it doesn't help us at all. So there's not really a point in uploading it at that time. Does that answer that question? I think so. We got anything else? I'm going to check our email real quick. Look at us, 5 minutes early. Nope. That's not what that is. Okay. I know I went through those very, very quickly. I promised to slow it down this afternoon when we talk about the CFA, because I know that's a bigger one. And maybe people will be more interested than capital assets. It's fine. All right, guys, we're going to let you break for lunch. I am going to leave this up and going so that you don't have to leave and come back. You could just leave your computer on if you want. You can leave and come back. You can use the same link that you used to get into it this morning. But we will be starting promptly at 1. To finish off the day with new ledge and then the schedule of expenditures of federal awards. So it'll be a fun afternoon. Well, have fun, eat lots of food.
Enjoy your lunch.
Enjoy it.